Credit insurance, a commercial broker's opportunity for new revenue and client retention. This course will provide brokers with an understanding of credit insurance and outline the opportunity it provides in a broker's portfolio of clients. This course is approved in several provincial jurisdictions as a continuing education opportunity. To earn online continuing education credits, this course must be completed at ilscorp.com. Credit insurance. What's in it for brokers? For the broker, credit insurance can be a new source of income with a low administrative burden. It can be your competitive advantage over the competition by enabling you to provide additional protection to your existing clients or a solution that opens the door to new customers. This 4-chapter course will give you a solid background on credit insurance. In the first chapter, you'll learn what credit insurance covers. The second chapter will provide you with an understanding of a credit insurance policy. Chapter 3 will discuss the growth of credit insurance nationally and globally, and the fourth chapter will outline the role of the broker and how to find credit insurance customers. We'll move on to the first chapter in just a moment, but first a short video on why credit insurance can be so valuable to business. Credit insurance. How does it work? A customer orders goods or services from its supplier. The supplier delivers the order on credit. Due to the time between the delivery of goods and services and actual receipt of payment, suppliers provide its customers with trade credit, in effect acting as their lender. It's estimated that this amounts to $400 billion in Canada alone. The problem? These days, the capital tied up in accounts receivable in this manner can account for as much as 30% of the asset side of the balance sheet. By making suppliers dependent on the payment behavior of their customers, high accounts receivable balances are becoming an increasing source of potential risk. The effects can be devastating. Even healthy companies, like that of our customer, can quickly run into liquidity bottlenecks. The result? It's not possible to pay for another delivery, and depending on how large the outstanding receivable is, this could result in financial difficulties or even bankruptcy for the supplier. It could, but our supplier has made provisions for this eventuality by taking out a credit insurance policy from Atradius, which pays out up to 90% in the event of payment default. It doesn't normally get to this point, however, for Atradius is continuously examining the customers of its insurance clients to determine their current and future credit worthiness. Atradius is able to rely on a global branch office network with locations in some 50 countries and has access to information on more than 200 million companies. Thanks to this early warning system, the policyholder is able to keep track of their business partner's creditworthiness at all times, allowing them to devote their attention to profitable transactions. Chapter 1. What credit insurance covers. Credit insurance can be a valuable risk management and financing tool for your client, but they may not be aware of the product, or they may not realize all of the valuable benefits of having this coverage in place. Credit insurance is also called accounts receivable insurance, as it protects the accounts receivable arising from business-to-business transactions from unexpected losses such as the insolvency of a customer, or when a customer cannot pay or pay in a timely manner, even though they're not insolvent. This is known as protracted default. Or if your client's an exporter, when political events obstruct a customer's payment, also known as political risk. So what are accounts receivable? They're the amounts owing for products or services supplied to a customer, but not yet paid for. Here's what we mean. An entrepreneur gets a great idea for a product or service. In this case, it's a new bike. He puts in equity, otherwise known as hard-earned cash, buys a factory and supplies to create his bikes, and he builds up his inventory. Now that he's spent all this money, he needs to make sales happen, and they do. His customers purchase lots of the products from the entrepreneur, but typically they can't pay immediately, as they have to sell some bikes first. So in order to facilitate the entrepreneur's sales, he agrees to provide bikes on credit to his customers and then waits for payment. At this point, the entrepreneur no longer holds the bikes and simply must trust that his customers will pay him in the agreed-upon time frame. So where does he get the money to pay his employees and his own suppliers for the materials used to make more bikes? The entrepreneur will borrow money from a bank secured by the accounts receivable he's holding. When those accounts receivable are collected, he repays the bank. But how's he supposed to repay the bank if his customers don't or can't pay? That's where credit insurance comes in, and chances are your customer is simply not aware of this type of insurance, and they should be, because it protects what is really the lifeblood of a company. When you open up the credit insurance discussion with a client, in all likelihood, you'll find that they have insurance protecting all company assets except accounts receivable. Many companies leave the security of their accounts receivable to chance, as they're not aware of credit insurance or don't understand what credit insurance is. This is where you can help them understand the benefits of credit insurance. Typically, credit insurance covers 90% of an invoice value, and that protection can be of enormous benefit to a company. Chapter 2. Understanding the Credit Insurance Policy. In Chapter 1, we briefly outlined what credit insurance covers. Now let's look a little closer at that coverage. Credit insurance covers two types of risk: commercial and country. Insolvency and protracted default fall under commercial risks. For insolvency in Canada, typically this involves a company filing for bankruptcy protection under the CCAA, Companies Creditors Arrangement Act, or the Bankruptcy and Insolvency Act, BIA. In the U.S., the bankruptcy protection would be filed as a Chapter 7 or Chapter 11 under the United States Bankruptcy Code. Of course, other countries have their own bankruptcy laws. Under country risks, also called political risks, credit insurance covers transfer risks associated with political and economic events that prevent or delay the transfer of payments. It also covers government moratorium, exchange controls, and discharge of debt risks that can occur when government legislation prevents the release of funds or absolves the buyer from its payment obligations. Country risks also cover contract frustration, when government action prevents the performance of the contract, or civil turmoil such as insurrection, war, and natural disaster. It's important to note that credit insurance does not cover disputes between parties. That's because the credit insurer is insuring the ability of the buyer to pay and is not insuring the insured's ability to perform their part of the contract. If the buyer will not pay because the goods that were received were not as ordered, that dispute must be settled in the insured's favor before a claim can be paid. Let's look a little closer at what trade credit insurance covers and how it can be used to benefit a business. From the financial perspective, credit insurance can help a business safely grow profitable sales. It can reduce the concentration risk to key accounts, and it can help a company sell on more competitive payment terms. It can also improve budget predictability and protect a company's profit, not to mention provide operational benefits to credit management. Credit insurance can provide corporate finance benefits such as improving bank financing with up to 90% margining on receivables. A company can leverage the collateral power of their accounts receivable, and this can improve working capital availability. From an accounting and tax perspective, businesses may be able to reduce bad debt reserves for a one-time accounting gain and potentially achieve the tax efficiency of insurance versus loss reserves. Given these benefits and the fact that credit insurance will typically cover 90% of an invoice value, which generally equates to all of the costs incurred but not the insured's profit, your prospect may be surprised to learn that it will only cost, on average, between 0.2 and 0.8% of sales. For example, for a sale of $100, that cost would be 20 to 80 cents. For large companies, it could be even less than that. And it's a minuscule cost when compared to the damage bad debt can do. There are a number of reasons why a prospect may want credit insurance. A needs assessment as part of the policy process will determine the goal for credit insurance. Is it to help the company support financing, to mitigate risk, to grow the business through increased sales, for concentration of risk, or is it for other reasons? So what options in the insurance policy will your prospect need? Well, there's a lot of choice. There's losses occurring cover versus risks attaching cover, whole turnover with cancelable credit limits, whole turnover with non-cancelable credit limits, select buyer cover, which encompasses just one or perhaps a few buyers with cancelable or non-cancelable credit limits, risk sharing options with differing indemnities, deductibles which affect price, political risk coverage, and many other sophisticated coverage options that, depending on circumstances, can be tailored to your client's needs. It's okay if you, the broker, don't have a strong knowledge of all of these insurance options, because the insurer will be happy to assist you in getting familiar. Once the why and the what have been determined, a policy application form must be completed to explain who the prospect is, what its sales are and have been, what its bad debts have been, who its major buyers are, and what its credit and collection procedures are. The application is then sent to the underwriter, who assesses the prospect risk, the insurability of the prospect's buyers, the policy structure, and the price of the policy. The underwriter is typically looking to spread the risk covered by the policy as broadly as possible, and ideally would like to insure all or most of your prospect's sales, while keeping close control over the risks accepted under the policy. The underwriter then looks at your prospect's buyers and adds the larger buyers to the policy by endorsement. Keep in mind that there could be some buyers that may be on the verge of bankruptcy, and so they'll be excluded. This exclusion is similar to a fire insurance company declining cover to a homeowner in the situation where the house is on fire and the homeowner's trying to purchase the fire insurance while he waits for the fire trucks to arrive. And you know, that's just not going to happen. Smaller buyers need to be assessed as well. To efficiently handle what is typically a large number of buyers, the underwriter assesses the credit and collection practices of the prospect. If those practices are acceptable, the policy will be accorded a discretionary credit limit amount. The insured itself will be able to set the credit limits up to that amount based on their credit and collection practices and policy conditions, without even having to ask the insurer for approval. Separate conditions are attached to the policy if your prospect does business in high-risk countries. The policy has three major components. Let's start with the declaration page. It identifies the insured and the broker, the policy period, the trade activities covered, as well as the policy limit of liability, countries covered, the credit limit conditions, maximum payment terms, the indemnity, deductibles, the premium details, and any other policy variables. The second component of the policy is the text. It outlines the risk covered, the inclusions and exclusions, the claim payment and premium payment processes, as well as the reporting and credit limit compliance requirements. The endorsements to the policy is the third major component of a policy. The endorsements identify the buyers covered and any changes to the text of the policy. What is the cost of a premium and when is it paid? The cost of the premium is typically based on total annual sales, although it can also be calculated based on monthly accounts receivable balances or based on the value of credit limits under the policy. Where the policy premium is based on sales, reports of sales insured under the policy are usually due to the insurer quarterly, semi-annually, or annually. Premiums that are based on monthly outstandings require reportings of outstandings on a monthly basis. Policy currency is usually in Canadian or US dollars, but the larger insurers will normally accept most major currencies. Commission to the broker is only payable upon receipt of the premiums. The premium is usually payable to the insurer, with the commission being forwarded to the broker thereafter, although some brokers do collect and pay the net amount to the insurer. From here, the policy gets issued, the premium gets paid, and as time goes on, the buyer limits are refreshed on an ongoing basis. Credit limits are requested on new buyers, discussions are held on deteriorating buyers, and on cancellation of limits for buyers who are no longer customers. Policy reporting on things such as past dues and sales must be completed as required. Claims happen. That's why credit insurance is purchased. It's the client's responsibility to report payment problems to the insurer sooner rather than later. Every effort to collect the payment or reduce or minimize the loss must be made. The client also needs to work with the insurer on any debt rescheduling. When submitting a claim, documentary evidence that is proof of the debt must be provided. So what exactly is documentary evidence? Proof of debt, which is the invoice or the contract. Proof of acceptance, such as shipping documents evidencing acceptance by the buyer. Proof of acceptance could also be from a trustee of the bankrupt estate agreeing that the amount is owing and admitting the debt to the bankrupt estate. A statement of account in evidence of the buyer coverage under the policy, which will be the written credit limits or the document supporting the discretionary credit limit decision. When making claims, it's worth repeating that disputes are not covered, and the dispute must be resolved between the insured and the buyer prior to the claim being paid. Insolvency claims are payable upon receipt of supporting information, but there are waiting periods for protracted default and political risk claims. Payments are made to the insured or the loss payee, and any recoveries are usually shared between the parties in the same ratio that the loss was borne. Chapter 3. Credit Insurance, a National and Global Perspective. Credit insurance originated in Europe in the mid-1800s through the British Commercial Insurance Company. There are claims that it existed before that in port cities, where marine insurers covering shipwrecks expanded their coverage to include damage to merchandise and pirating, eventually offering payment guarantees for goods shipped. In the 1990s, prior to industry consolidation, there were more than 35 credit insurers worldwide. Today, the big three accounts receivable insurers are Atradius, Euler, and Coface, accounting for 80 to 85% of all global credit insurance premiums. The Receivables Insurance Association of Canada was established in 2013 to promote the business opportunity for receivables insurance, also known as trade credit insurance, to Canadian insurance brokers, the banking industry, and businesses engaged in domestic trade and exporting. It's comprised of all of the Canadian receivables insurance underwriters, the two largest brokers in Canada, other specialist brokers who play a significant role in the distribution of credit insurance in Canada, and other interested parties, including banks and law firms. The Canadian market for credit insurance is currently around $200 million, posting steady growth from $20 million in 1990. Projections from RIAC suggest that with wider recognition of the product within Canada, the potential market size, assuming a realistic penetration percentage, is actually 4 times that. The number of brokers familiar with credit insurance is growing rapidly, and educating the business community about the value of credit insurance will fuel growth. As credit insurance originated in Europe, they are well ahead of North America in terms of market penetration. But there's plenty of opportunity for growth in Canada and the US. Chapter 4. The Role of the Broker. So where can you find credit insurance clients? The easiest place to start prospecting is in your own client database. These are warm leads, and it's quite likely some of your clients have credit insurance, but you aren't receiving a commission. On renewals, be sure to add a short questionnaire on credit insurance so you don't miss any opportunities. Your clients will thank you. Another area where you can find prospects in a somewhat easy fashion is if you have clients who refer prospects to you for credit insurance. These warm leads may have come to you for credit insurance, but this opens up the opportunity to discuss other types of insurance with them as well. As you move further away from your client base, prospecting becomes more difficult, but you may receive direct calls from another line of business or a client. This is a somewhat warm lead, as a basis of a relationship is already there, but the knowledge of credit insurance may not be, so you'll need to sell the idea of credit insurance to them. The most difficult approach to prospecting is cold calls. It's important to use a good contact list. You should target owners of small companies or the CFO of larger organizations. Initially contacting them by email with a follow-up call is an effective approach. When you find a prospective client, you'll need to get an understanding of their business, and there are some telltale signs to look for. You should look at the concentration of customers in their accounts receivable and watch for red flags. For example, is the bulk of their business with one major buyer? Also look at the quality of the buyer's business sector, and if it's a seasonal business. Consider the industry and trade sector the prospect is in, as some are more stable than others, and also look at the margins of the prospect, as low margins will require a dramatic increase in sales to cover a loss if they're not credit insured. Here are some things to know about premiums. Policy premiums will vary dramatically, with the median policy size being $35,000. The minimum policy size being typically $7,500, while large policies can result in premiums in the millions. Commission rate is commensurate with the expertise and independence of the broker, and how much involvement is required from the insurer. The income per policy is almost always in the thousands. Credit insurance is designed to protect a business from the impact of bad debt. Like all insurance, it needs to be purchased before it's needed, so there may be years where the cost of the policy is more than the cost of the bad debt. However, it more than pays for itself when bad things happen to a good company. And as we mentioned earlier, the security it provides can help a business grow. In this example, in year 6, that one large bad debt could put a company out of business if it's not insured. As a broker, you know your business is all about relationships, and offering credit insurance is no different. Make exploring and purchasing credit insurance an easy process for your clients by assisting in the application process, explaining the prospect's needs to the insurer, assisting your client when they're unsure about assuming new risk, explaining the policy conditions, assisting your client with reporting reminders, participating in the policy renewal process, and collecting premiums and commission. As a broker, you should consider credit insurance clients, as they can provide a new source of income, and if you are leveraging existing clients, the time and effort for that sale can be minimal. Credit insurance can get you in the door to new prospects, and it can also be the differentiator that protects your business from the competition. If you'd like more information on becoming a credit insurance broker, please visit our website, atradius.ca, or contact us.